All right, welcome to this explainer. Today, we're diving into a wild disconnect that happens all the time in the business world, but honestly, it rarely gets analyzed quite this clearly. We're looking at the massive gap between a product's real-world utility, like how much it actually helps a company on a day-to-day basis, and its stock market reality. How on earth can a product be a massive win for its customers, but a brutal loss for its investors in the exact same quarter? Well, that is the Yubico paradox, and we are going to unpack it step by step.
Here's our quick roadmap for today. First, we'll look at the 203% ROI success story. Then, securing the remote workforce. Third, Burka Equity's Q1 struggle. Fourth, portfolio winners and losers. And finally, utility versus market valuation. Let's get into it.
Section 1. The 203% ROI success story.
203%. That is a completely staggering return on investment. And it's exactly what organizations are hitting over 3 years when they use Yubico's YubiKeys as a service. Now listen, this isn't just some fluffy marketing claim, right? This comes straight from a total economic impact study commissioned by Yubico and conducted by Forrester Consulting. They looked at a composite organization of about 5,000 employees using Yubi Enterprise subscription and delivery services. When a company rolls out these physical security keys under this specific model, the financial return is simply exceptional. But you might be wondering, where exactly is that 203% coming from?
Well, it boils down to 5 distinct operational benefits that are driving that incredible ROI. Instead of buying a giant box of security keys and just, tossing them in an IT closet, companies get ultimate flexibility. They literally only pay as their business evolves. We're talking direct cost savings per user every single month, plus they always have access to the latest hardware. But arguably the absolute biggest wins are those last two: turnkey delivery and remote worker management. Your highly paid IT security team isn't acting as a mailroom anymore, stuffing envelopes and shipping keys to remote employees. The service just handles all of it globally.
Moving on to Section 2. Securing the remote workforce.
You can almost hear the sigh of relief from BeyondTrust's Chief Security Officer Maury Haber right here. He points out that it's just huge, not having to worry about inventory, shipping, tracking, or delivery. BeyondTrust is a massive leader in privileged access management, and they actually adopted this exact service to future-proof their incredibly aggressive growth plan. They were onboarding new employees rapidly across multiple countries. So by offloading all that logistical headache to Yubico, BeyondTrust could focus on what actually matters: deploying a zero-trust architecture. That's a framework where absolutely no user or device is trusted by default, and you replace those super vulnerable passwords with hardware-backed security.
The real game changer here is absolute budget predictability. What this subscription model does is it shifts security from being this painful, massive upfront capital expenditure, a huge CapEx burden, into a super smooth, highly manageable operating expenditure, or OpEx. I mean, for a CFO or a security leader, this is basically a dream come true. You get the agility to scale up or down as your business churns, replacing keys as employees leave or join, without completely blowing your quarterly budget on hardware that's just going to sit in a desk drawer somewhere.
All right, Section 3. Burka Equity's Q1 struggle. Okay, brace yourselves for some serious financial whiplash. Because while Yubico is out there saving enterprise clients a ton of cash with that 203% ROI on the ground, their stock, it completely cratered. We're talking a 54.4% drop in the very first quarter of 2026. This was driven by a really negative market reaction to several listed portfolio companies' fourth quarter reports. The market fundamentally looked at the on-the-ground reality of this product's utility and just completely disagreed.
And of course, when a stock drops like that, it drags its major investors right down with it. Take a look at Burka Equity. Their net asset value started 2026 at a very healthy 19,823 million Swedish krona. Fast forward just 3 months, that drops to 18,046 million. That is a brutal 9% hit to their net asset value per share in a single quarter.
If you dig into exactly where that bleeding happened, it was heavily concentrated in their listed portfolio. Just look at the change in value for Yubico alone, negative 673 million SEK. That one single line item acted like a massive anchor, dragging down Burka's overall quarterly performance, entirely wiping out any gains they managed to scrape together elsewhere in the portfolio.
Which brings us to Section 4, portfolio winners and losers.
Let's take a look at the unlisted SaaS company, Mentimeter. Operationally speaking, they were crushing it.
The report shows they actually had a sharp improvement in earnings in 2025 and a really stable start to 2026. But despite all that great news on the ground, they took a 173 million SEK write-down. Why? Strictly because the market was totally spooked about how AI might impact software as a service valuations going forward. It was a structural revaluation driven entirely by AI anxiety, completely divorced from Mentimeter's actual stable earnings.
You can really see the massive juxtaposition here between punishing drops and surprising recoveries within that exact same quarter. On one hand, you've got Yubico dropping 673 million SEK and Vitrolife plummeting a staggering 920 million SEK. But then, on the flip side, the medical tech company Ex Vivo Perfusion actually saw a recovery, adding 191 million SEK in value. And the crazy part? Underlying fundamentals across the board were mostly solid. Vitrolife even reported growth and improved margins. But market sentiment in Q1 was just ruthlessly unforgiving to very specific sectors.
But hey, it's not all a sea of red, right? The market will absolutely still reward the right story when the timing is perfect. Case in point, a massive 247% jump. That's what happened when the semiconductor manufacturer Silex Microsystems went public just after the quarter closed in May 2026. On day one of trading, their stock skyrocketed. The market absolutely loved their strong Swedish ownership base and their position as a world-leading supplier of MEMS technology, which are those microscopic mechanical systems used in modern electronics, especially as they navigate a super complex geopolitical landscape.
Finally, Section 5, Utility versus Market Valuation. Bird's CEO Henrik Blomquist really hit the nail on the head regarding the entire climate here. He pointed out how the already tricky global market just worsened, specifically calling out geopolitical strife in the Middle East and potential economic spillover effects. And the crazy thing is, those macro fears completely overrode some genuinely amazing company performance. Companies in this portfolio, like Mycronic, hit record sales and profits. Vitrolife grew. Ex Vivo grew by 23%, yet the broader market sentiment stepped in and punished their valuations anyway.
So I'm going to leave you with this provocative thought. We've seen the hard data today. When a product like YubiKeys as a service is an absolute home run for IT departments, literally guaranteeing a 203% return for customers and modernizing remote security, but at the very same time, it loses half its stock market value in just 3 months because of macroeconomic panic, who's actually pricing its worth accurately? Is it the customer carefully balancing their OpEx budget, or the day trader reacting to a geopolitical headline? It's a fantastic reminder that in the business world, creating immense real-world value doesn't always equal a rising valuation. Thanks for joining me on this explainer, and I really hope this changes how you look at the next earnings report you read.